All right, this is where we left off with the discussion on this problem, right? So I was just talking about how interest and principal goes up, goes down, right? Interest goes down typically, and principal goes up typically, as long as the payment is fixed. All right, so what I wanted to show you is I'm going to show you this with an actual mortgage to show you how this works. So if you were to go, I just grabbed bankrate.com, you can go to pretty much anything, pretty much any banking website. I'm going to go to mortgages, and I'm going to go to amortization calculator. And like I said, you could just Google amortization calculator. I could do mortgage payment calculator. They're really the same thing for our purposes. Let's pretend we're buying a house. You're not buying many houses in New Jersey for $165,000. Let's go a little higher than that. Let's go with $400. All right, $400,000. You can change the mortgage term. Typically, it's 30 years. It can be 15 years, but we'll stick with 30. Interest rate, I guess, currently is about 4.5%. And we're just going to hit calculate. So $400,000 loan, calculate. Okay, so it gives us the totals. It tells us what our monthly payment's going to be. So it tells us like that leftmost column there. And I wanted to show you the amortization schedule. Here it is below. Most people don't look at this. It's got a few more columns than mine because they have a summary column here somewhat. But the idea is here's the payment. Here we have it opposite. Here's the principal, here's the interest, and here's the balance of the loan. Okay, so ignore the total interest column because that was not in my grid, but these other pieces were. All right, and as you can see, as you make each payment, the interest is continuing to go down and the principal piece is continuing to go up because you're always working off of a lower number. All right, so if we go all the way down this thing, all whopping 30 years of it, just grab. Ooh, there we go, too far. Here's our last round of payments. By the time we get to our last round of payments, the $2026.74 is our fixed regular monthly payment. But as you get to the end, since you're calculating off of such a low loan balance, get rid of this. Since you're calculating off of such a low loan balance with the $4,000, your interest was only $757 in the last month, and it's entirely principal towards the end. So you can see the reason the interest is higher at the beginning, you're paying primarily interest, is because you're calculating your interest calculation off of the higher loan balance, the outstanding bill. Okay, so now here's what I want to kind of show you. That loan we took out was $400,000. We paid $329,000 of interest. So really that $400,000 house just really cost you $729,000. Rather shocking, right? All right, I just want to show you one more thing, and then we'll get back to the actual regularly scheduled class here. What happens if we add extra payments? Now, I get that a lot of people, money's tight, all those things. But if you could add some extra to your payments and you designate that payment to go against principal, it will have a dramatic effect long term on your loan. Okay, so as of right now, our total interest paid is $329,000, and it ends after 30 years, right? Our payoff date is June 2051 right now. What if I had an extra like $100 a month, just $100, right? You didn't go to Starbucks for a month. You add an extra $100 payment, and we're going to apply it to your monthly mortgage payment. So that $100, that little bit extra, is going to go directly against principal. All right, so remember we're at $329 right now of interest. Now I'm going to apply those extra payments. My interest went from $329 to $294. Okay, I saved about $35,000 in interest by just paying $100 extra a month. And instead of my loan ending in 2051, it ended in 2048. That's significant. All right, so what I would suggest, if you have a mortgage or you have a family that has a mortgage, you run these for them. They have their mortgage information available, like everybody does. You just log in and you get your mortgage information and see what kind of impact that would have. Let's say we have a lot of money, like we have an extra $300 a month. Okay, I know we might be stretching here now, but let's just pretend. So we had $300 a month extra, we applied that extra payment, now we're down to $243. Okay, originally it was $329. So you've saved, about $80,000? I don't know, can't do that in my head real fast, but about that. All right, you've saved about $80,000 by paying an extra $300 a month. And your loan is done how about 7 years early? How about that? Okay, so it is a dramatic difference when you make that extra little bit of payment towards your principal. Now, $300 I know is more than a little bit, but the idea is that you're knocking down that principal by putting that extra little bit of payment straight to principal, not to interest. It makes a dramatic impact in the long run. Okay, so that's my little 2-minute diatribe on that. Let's move on to talking about bonds. That is another typical long-term debt. Long-term debt issued to multiple lenders called bondholders. Now the idea is the other ones were loans, right? We were borrowing money as a loan from like a bank or some sort of lender. Bonds, however, are long-term debt that I'm selling to many people. So I could issue as a company a bond issuance, and I could sell, rather than one $1.5 million loan to one place, instead I could sell $150,000 bonds to everybody. So I could put it out there that bonds are typically $1,000, $5,000, $10,000, right? So the idea is that people invest. They loan me money with the bond, right? So if I'm the company, they loan me money. They give me $1,000 towards their bond, right? I give them a bond back to them. And what I do is I'm guaranteeing them interest for a period of time, 5 years, 10 years, whatever that time period might be. And at the end of that time period, at the end of, let's say, 5 years, I have to then return their money to them. Okay, so it is a loan, but it's a loan like it's an investment for people. So I'm putting the loan out there. I'm asking for money from, a multitude of people, many, many bondholders. They're loaning me the money. I'm paying them interest. And at the end of the life of the bond, I then return their money to them. Okay, so people invest with bonds and they like that because I'm giving them a guaranteed amount of interest, right? It's a nice passive source of income for people. And I'm getting a loan not just from one bank, but from many people with the terms I'm setting. I'm saying I will pay 6% interest, whereas maybe my loan might be 12%. Okay, so I'm setting the terms if I'm the one putting the bonds out there. And it's just another way to fundraise money to get it to me to expand operations in my business. So there's a bunch of different types of bonds. You've got term bonds where all the bonds mature at the same time. Like I said, let's say I put out 50,000 bonds. All 50,000 bonds are going to come due at the same time if they're term bonds. That's a lot of money to put out. But that's the way, if I set it up that way, that's the way it is. Serial bonds. Bonds mature in installments over several dates, over periods of time. So I don't have that big, giant balloon payment at the end. A different kind of, okay, so there's term and serial. A different kind of type of bond that you might hear is a secured bond. And a secured bond is when assets are pledged as collateral for the bond. Let's say you wanted to invest with me. I'm trying to raise money from bonds, and I've got a tiny little donut business. All right, that's my fantasy one day. Anne Marie's Donuts. All right. So the idea there is you may not want to invest with Anne Marie's Donuts because you don't know me, right? You don't know if I'm a good investment. You don't know if I'm going to be around in 10 years to pay you back your bond, right? So I might say, okay, I own the building and I own the land. If you loan me the money and I don't pay you back, I will sell off the building and the land in order to repay you. So that's pledging assets as collateral. The more common type, that's less common. The more common type of bond you see, or that you as a regular investor would be dealing with, is actually called an unsecured bond or a debenture bond. Bonds are only backed by the credit of the organization. So, simple example, let's say I wanted to buy a bond with Microsoft. I'm not worried about Microsoft going anywhere. I don't need them to pledge their building as collateral. I'm pretty darn sure they're going to pay me back. So if that's the case, that is a bond being secured just by the credit of the organization, just because you know them, you know their name, you know they're good for it, all of those things. Okay, that's your more typical bond. A little bit of bond terminology. The face value is the amount that the borrower must pay to the bondholder, right? So I was saying, if it's a $5,000 bond, that's going to be written on there. That is the face value of the bond. Maturity date, when does the money have to get paid back to the bond lenders? There's going to be an interest rate that is stated on the bond, right? So I say it like it's on paper. I get that they're not on paper, they're electronic now, but it's kind of easier to visualize on paper. So the value of the bond would say, I owe you $5,000, basically, bondholder, the maturity date, when it's going to come due, and what the interest rate is that the lender No, the bond lender, bondholder. No, bond lender is going to pay to the bondholder. Premium and discount. Well, premium is actually when the bond's sold at a higher price than the face value. And we'll go into an example of that. And a discount is when bonds are sold at a lesser price than the face value. So if it's a $5,000 bond, you pay more if it's premium, you pay less if it's a discount. Well, why would you pay more or less? That leads us into our next conversation and our next video. Okay, this isn't a very long chapter, but there's a lot to talk about.